Welcome to The Explainer. Today, we are cutting through all the noise about AI and job cuts. I mean, everyone's talking about how the workforce is changing, but we're going to follow the money and really look at the financial impact of all these massive layoffs. You've seen the headlines, right? You've heard all the warnings. For a while, the story out of Silicon Valley was that AI would make us all more productive down the line. But the short-term reality is hitting, and, well, it looks a lot like automation is reshaping the workforce starting right now. And the scale of this is just staggering. In the past year alone, the tech industry has cut over 100,000 jobs. And we're not talking about small startups. We're talking about the biggest names out there. Amazon, Meta, Google, they're all leading this new charge. Yeah, this isn't some distant, hypothetical thing we might have to deal with someday. Companies are actively using technology to streamline what they do, and it's creating this huge, immediate shift all across corporate America. I mean, just look at these numbers. Amazon cut 14,000 corporate jobs. Meta got rid of 600 jobs at the exact same time it's pushing a huge expansion into AI. These are not small tweaks, these are massive workforce reductions happening in lockstep with huge investments in new AI strategies. Okay, so let's really dive into this. Why is this happening on such a massive scale? What's the official story coming out of the boardrooms? Well, experts say it's basically a perfect storm. First off, AI is getting shockingly good at automating those routine white-collar jobs. Data analysis, marketing, even some coding. That means you just don't need teams as large as you used to. Then you've got a tougher economy pushing companies to slash costs. And finally, a lot of people are calling it a post-pandemic right-sizing after all the hiring sprees a few years back. The whole idea is to get leaner, more agile. So all these companies are making the exact same move, and they say it's for the long-term health of the business. But here is the big pivotal question that almost no one asks. Does this strategy of mass layoffs actually work? Does it do what they say it's going to do? To answer that, we need to be really clear on the definition here. This comes from a huge meta-analysis of almost 40 years of research. So downsizing isn't just cutting jobs. It's the intentional reduction of a workforce with one specific goal in mind: to improve future financial performance. That last part, that goal, is absolutely key. And the strategy is pretty much always sold the same way. You have to accept some short-term pain for both the employees and the company in exchange for a much healthier, more profitable future. It's presented as this simple trade-off, right? The pain is obvious. It's tough for employees, but there are also direct costs like severance packages, and a lot of times the stock takes a hit. The promised gain is a leaner, meaner, more profitable company. But does the data actually support that promise, or is it just a convenient story? Now, what's really fascinating here is how reason for downsizing has completely changed over the decades. Back in the 80s, it was a defensive move. You only did it if your company was struggling, and it carried a real stigma. But then the 90s hit, and suddenly it was this popular, even cool strategy for healthy companies. And since the 2000s, it's kind of shifted back again. That context is so important. So let's get to the data. Let's see what nearly 4 decades of research tells us about the actual results of all this supposed short-term pain. And this, right here, is where the whole conventional wisdom just completely falls apart. In the short term, companies that downsize actually perform worse than their peers who don't. But the long-term result? It's even more shocking. 2 or more years after layoffs, the internal financial performance of the company itself generally goes down. The big question now is whether the efficiency promised by AI will somehow break this very long-standing pattern. So let's be crystal clear. After looking at 905 separate academic studies, 905, the big, comprehensive conclusion is that there is little to no evidence of long-term financial gain from downsizing. That silver bullet for profitability that everyone thinks it is, the data says it just isn't there. Okay, so if long-term profits don't really improve, maybe there's another benefit, right? Especially when the cuts are tied to a hot new technology, like AI. What about the stock market? Does Wall Street reward these moves? This chart just illustrates it perfectly. Look on the left. When a struggling company announces layoffs, that's a defensive move. The market reacts negatively. The stock goes down. But on the right, when a healthy company downsizes, an offensive move, like we're seeing in tech today, it gets this little tiny positive reaction from investors. But, and this is a huge but, even that small positive bump in the stock price, it's often gone in a flash. The research shows these gains are usually fleeting. They disappear within days, and they absolutely do not lead to the sustained, strong financial performance that companies claim they're aiming for. This quote from the researchers just reframes the entire conversation. We're always told downsizing is for the greater good of the company, but the data shows that good is not a long-term financial gain. Instead, it's more often an attempt to just stop the bleeding, to mitigate losses, not to actually get ahead. And that leaves us with one final critical question, especially now in the age of AI. If downsizing doesn't reliably lead to long-term profit and any stock market bump is temporary, what exactly is the greater good that all these massive, disruptive, and often painful corporate decisions are really serving? Because the data suggests we need a much better answer. The one we've been given just doesn't add up.